success in the financial markets is not monolithic. While many participants follow the well-trodden paths of value or growth investing, a select group of titans forged their empires using radically different, often misunderstood strategies. They did not simply buy and hold. They speculated, they systematized, they agitated, and they engineered. Their success was not a product of luck, but the result of a clearly defined, rigorously applied operational model that was often contrary to conventional wisdom. Today, we deconstruct the methodologies of 15 such market titans. We will move beyond simple biography to dissect the core principles and actionable frameworks that underpinned their legendary careers. This is an examination of the blueprints that built market empires. To build this foundation of strategic thinking, there is no greater resource than the one book read by nearly every market master, Edwin Lefebvre's classic Reminiscences of a Stock Operator. It is the thinly veiled biography of the first titan we will study, Jesse Livermore. To help you absorb its timeless lessons on market dynamics and mass psychology, we've linked in the description a unique chapter-by-chapter analysis by Max Davidson, specifically designed to translate its century-old wisdom for the modern trader. Consider it required reading to understand the mindset that makes these strategies possible. Our first titan is perhaps the most mythologized figure in market history, Jesse Livermore, the father of pure speculation. Livermore was not an investor. His strategy was an aggressive and disciplined assault on major price movements. Operating in the early 20th century, an era of bucket shops and minimal regulation, he learned that the market was driven by immutable human emotions, hope, fear, and greed. His methodology was designed to exploit these emotions while insulating himself from them. The core principle was to trade only with the dominant trend, what he called the line of least resistance. He would wait patiently for what he termed pivotal points, critical price levels, often new all-time highs or lows, where a breakout would signal the start of a sustained move. He never bought a stock simply because it looked cheap, nor sold one because it seemed expensive. The price action was his only truth. Once a pivotal point was breached and a trade was initiated, Livermore employed his signature tactic of pyramiding. If a stock moved from $100 to $102, confirming his initial analysis, he would add to his position, not before. He added to his winners, never his losers, using the market's own momentum to build a large line of shares with a favorable average cost. His risk management was equally brutal and simple. He preached the 10% rule, an automatic sale of any position that moved against him by that amount. This rule was non-negotiable, designed to cut off emotional attachment and prevent catastrophic losses. His legendary shorts before the 1907 and 1929 crashes were not lucky guesses. They were the culmination of his strategy. He observed the signs of a topping market, narrowing leadership, speculative excess in low-quality stocks, and climactic volume with no price progress, and acted decisively. Livermore's strategy is a timeless lesson in controlled aggression, where success is a function of patience in waiting for the perfect setup, courage in exploiting it, and absolute discipline in managing the risk. Building a trading career is about instilling the right habits from day one. As the philosopher Aristotle taught, we are what we repeatedly do. Excellence, then, is not an act, but a habit. The habit of disciplined research, of formulating a clear strategy, and of executing that strategy without emotional attachment is the key to longevity in this profession. Subscribe to this channel and return often to reinforce these principles. Let this be the place you come to forge the habits that will define your future. From the intuitive speculator, we turn to a man who fused fundamental analysis with a rigid technical system. Nicholas Darvas. A professional ballroom dancer, Darvas was the ultimate outsider who, through logic and isolation, developed a complete techno-fundamental hybrid strategy. His process began with a fundamental filter that sought out companies with explosive potential. He was not interested in staid, blue-chip names. He wanted industry disruptors with revolutionary products and, critically, a history of dramatically accelerating earnings growth. He reasoned that truly massive price moves are always fueled by massive earnings surprises, the one thing that gets institutional money excited. He would screen for stocks already hitting new 52-week highs, operating on the principle that strength begets more strength. Once a stock passed his rigorous fundamental screen, his purely technical box theory became the operating system for the trade. He observed that leading stocks move up in a staircase fashion, a sharp advance followed by a period of consolidation within a narrow price range, which he called a box. The top of the range was resistance, the bottom support. He would place a buy stop order just above the top of the box. His rule was absolute. He would only enter a position when the price proved its strength by breaking out to a new high. Immediately upon entry, he would place a stop-loss order just below the bottom of that same box, ensuring his risk was always defined and limited. As the stock moved higher and formed a new higher box, he would trail his stop-loss up to the floor of the new consolidation. This mechanical approach to trade management forced him to cut his losses unemotionally and, just as importantly, forced him to ride his winners for as long as the trend structure was intact. The Darvas method is a powerful case study in creating a holistic process that separates stock selection fundamental from trade management, technical, a key to disciplined, emotion-free execution. Our third titan is William J. O'Neill, an architect who built one of the most comprehensive and popular hybrid systems ever devised, the CANSLIM methodology. O'Neill's strategy is a powerful fusion of quantitative fundamental analysis, chart analysis, and overall market timing, designed to identify the market's true superstocks before they make their most explosive gains. Each letter represents a core principle. The C for current quarterly earnings demands a significant year-over-year increase of at least 25 to 30%, a sign of powerful current momentum. The A for annual earnings growth looks for a consistent track record of at least 25% growth over the past 3 to 5 years, confirming the company's long-term viability. The N signifies a new product, new management, or a new high in the stock price. O'Neill found that major price moves are often preceded by a significant corporate catalyst, and he insisted on buying stocks as they emerged from price consolidations to make new highs. The S stands for supply and demand. He preferred companies with a smaller number of shares outstanding, as a small amount of buying could have a larger impact on the price. He also looked for signs of large institutional accumulation in the volume data. The L is for leader or laggard. His rule was absolute. Always buy the leading stock in a strong industry group, the one with the highest relative strength rating, never a sympathetic or lagging name. The I stands for institutional sponsorship, demanding that the stock be owned by at least a few well-performing institutional funds, whose buying provides support, but not so many that the big money has already been made. Finally, the M is for market direction. The entire system is predicated on being heavily invested only during confirmed market uptrends. O'Neill's strategy is a masterclass in building a multi-layered, evidence-based approach that leaves nothing to opinion or guesswork. While O'Neill created a complex system for discretionary use, our fourth titan sought to prove that a successful strategy could be purely mechanical and even teachable. Richard Dennis, a legendary commodities trader, famously wagered that he could train ordinary people to be great traders. This led to the turtle traders experiment, and the strategy they were taught was systematic trend following. The core of the strategy was to remove all human judgment and emotion from trading decisions. The turtles used two related systems, both based on Donchian channels. System 1 was a short-term system that entered on a 20-day breakout and exited on a 10-day breakout in the opposite direction. System 2 was a longer-term system that entered on a 55-day breakout and exited on a 20-day breakout. This dual system approach ensured they would catch both short-term and major long-term trends. Crucially, their risk management was just as systematic. Their stop losses were determined by the market's recent volatility using the average true range ATR. A more volatile market demanded a wider stop, ensuring that market noise would not prematurely stop them out of a good trend. Furthermore, their position size was always a function of risk. Every trade was sized so that a 2 ATR move against them would result in a loss of no more than 1 to 2% of their total account equity. This meant they took smaller positions in volatile markets and larger positions in quieter ones, keeping their dollar risk per trade constant. The turtle strategy demonstrates that a trading edge does not need to be complex. A simple set of rules for entry, exit, and risk management, when applied with perfect unwavering consistency, can be extraordinarily profitable. Our fifth titan, Jesse Livermore, is a pioneer of computational trend following who takes the turtle philosophy to its psychological extreme. He was one of the first to use computerized algorithms to backtest and execute trend-following strategies in the 1970s, turning a few $1,000s into many millions. For Livermore, the specific parameters of the system are less important than the trader's unwavering commitment to following it. His core strategy is pure, emotionless execution of a tested model, believing that the primary challenge in trading is not intellectual but psychological. His famous trading maxims are a guide to this philosophy. Ride your winners, cut your losers is the essence of trend following. If I am bullish, I expect to be profitable. If I am not profitable, I am not bullish, highlights his reliance on market feedback over personal opinion. His belief that good trading should be a happy, careless state reveals the goal of his approach: to eliminate the stress and emotional turmoil that plague discretionary traders. If a trade is causing anxiety, it indicates a violation of the principles. Either the rules are being broken, the position is too large for one's emotional tolerance, or there is a fundamental lack of faith in the system's edge. Livermore's strategy, therefore, is as much about psychological programming as it is about computer programming. He famously stated that everybody gets what they want out of the market, implying that those who secretly crave the thrill of risk and failure will find it, while those who truly want consistent profits will adopt the discipline required to achieve them. From systems, we turn to macro analysis with Paul Tudor Jones, a titan whose strategy is built upon a foundation of obsessive risk management and the search for asymmetric opportunities. His entire methodology is designed to survive catastrophic events and to capitalize on moments when the market's perception is deeply flawed. The cornerstone of his strategy is what he calls the 5-to-1 rule. He will not enter a trade unless he believes he has a realistic chance to make $5 for every $1 he is risking. This forces him to be incredibly selective, waiting for opportunities where the risk-reward profile is massively skewed in his favor. This often leads him to be a contrarian, betting against a euphoric consensus at market tops or buying into a climate of fear at market bottoms. His execution of this strategy before the 1987 crash is legendary. By meticulously analyzing the market's price action and comparing it to the historical analog of 1929, he became convinced that the market structure was dangerously unstable. He took massive short positions, not as a blind gamble, but because the 5-to-1 logic was in place. If he was right, the profits would be monumental. If he was wrong, his predefined stop-loss meant his losses would be small and manageable. His mantra of defense, defense, defense illustrates that his primary focus is not on making money, but on not losing it. He views his trading capital as the most precious asset, the loss of which means he is out of the game. This defensive mindset and rigorous application of asymmetric risk is his enduring strategic legacy. Our seventh titan operates on a completely different battlefield. Carl Icahn is the titan of activist investing. His strategy is an aggressive interventionist approach to forcing change and unlocking value. He does not passively wait for the market to recognize value. He becomes the catalyst that forces it to be realized. His process begins by identifying companies that he believes are fundamentally undervalued, not because of market oversight, but because of poor management. He looks for good businesses with valuable assets that are being squandered by a lazy, entrenched, or incompetent leadership team. Once a target is identified, he amasses a large, influential stake in the company, often 5 to 10% or more. With this leverage, he launches a public and private campaign to force change. This can include demanding seats on the board of directors, agitating for the sale of underperforming divisions, pushing for massive share buybacks to return capital to shareholders, or advocating for the outright sale of the entire company to a better operator. His strategy is a form of corporate arbitrage, betting that he can buy a company for $50 a share and, through his aggressive actions, force its value up to $80 or $100. The Icahn lift is a recognized phenomenon where a stock's price jumps simply on the news of his involvement, as the market anticipates the value he will unlock. From corporate warfare, we turn to a strategy of elegant simplicity. Joel Greenblatt is a titan who sought to codify the principles of value investing into a simple, quantitative system that anyone could use. This became his famous magic formula. His strategy is a form of quantitative value investing that bridges the gap between the deep, qualitative analysis of Graham and the complex algorithms of quant funds. The magic formula is based on the timeless idea that buying good companies at cheap prices is the most reliable path to long-term returns. It defines good and cheap with two specific metrics. To find good companies, it uses return on invested capital, ROIC, a powerful measure of how efficiently a company's management uses its capital to generate profits. A high ROIC indicates a strong business with a competitive advantage. To find cheap companies, it uses earnings yield, which is earnings before interest and taxes divided by enterprise value, a robust measure of how much profit the company is generating relative to its total price tag. The strategy involves ranking all available stocks by both metrics, combining the ranks, and buying a portfolio of the top-ranked companies, rebalancing annually. Greenblatt's extensive backtesting showed this simple two-factor model dramatically outperform the market over the long term, proving that a successful process does not need to be complex. Our ninth titan represents the world of professional short-term trading. Linda Bradford Raschke is a legend who built her career on the disciplined execution of short-term, pattern-based swing trades. Her strategy is rooted in the belief that markets, on a short-term basis, exhibit repeatable patterns driven by the enduring constants of human psychology. Her approach is not about long-term forecasting, it is about capturing the meat of the move over a period of a few days by identifying high-probability setups. Her strategies often involve identifying points of momentum exhaustion or trend resumption. She is a master of identifying the market's rhythm and flow. For example, she is known for her mastery of classic techniques like the turtle soup pattern, a reversal strategy that bets against a false breakout to a new 20-day high or low, fading the emotional traders who get trapped. She also applies principles from the Taylor trading technique, which breaks down the market into a 3-day cycle of buying, selling, and selling short. The core of her strategy is rigorous observation, precise entry and exit rules based on visible patterns, and a relentless focus on the present moment of the market. Her success proves that a long-term career can be built not on predicting the big picture, but on the consistent, disciplined exploitation of small, recurring market patterns. Next, a titan who engineered a strategy to transcend market cycles entirely. Ray Dalio. As the founder of Bridgewater Associates, the world's largest hedge fund, Dalio's strategy is a macro approach based on a deep, mechanical understanding of the global economy. His core philosophy is that the economy is an economic machine driven by predictable, repeatable cycles, particularly the long-term, 50 to 75-year, and short-term, 5 to 8-year debt cycles. By understanding which phase of the cycle we are in, it is possible to anticipate the probable direction of various asset classes. Based on this worldview, he developed his most famous strategic innovation, the all-weather portfolio. This is a portfolio construction strategy, often associated with risk parity, designed to perform reasonably well in any economic environment, whether it is a period of rising growth, falling growth, recession, rising inflation, or falling inflation, deflation. The strategy achieves this by balancing assets not by their dollar amounts, but by their risk contribution and their environmental bias. It is a radical departure from traditional stock-heavy portfolios, designed to produce a stable return stream with minimal drawdowns. Dalio's overarching strategy is to deconstruct the global economy into a set of timeless and universal principles, and then to build a truly diversified system that is not dependent on correctly forecasting any single outcome. Our 11th Titan is Michael Steinhardt, a hedge fund legend whose strategy can be summarized as variant perception. His core thesis was that the only way to earn outsized returns was to hold a view that was fundamentally different from the market consensus and then to be proven correct. His strategy was a relentless pursuit of an informational and analytical edge. He was a master synthesist, combining deep macroeconomic analysis, granular industry knowledge gleaned from countless sources, and technical chart reading to form a unique thesis that others were missing. Steinhardt's approach was famously aggressive and eclectic. He was willing to trade anything, stocks, bonds, currencies, long, short, anywhere in the world, as long as he believed he had a demonstrable edge. He was known for his intense grilling of company management and his vast network of contacts to uncover information. His strategy underscores the immense intellectual work required to move beyond simple technical or value-based approaches and into a realm where success is predicated on seeing the world more clearly than the competition. Next is Bruce Kovner, a global macro titan who attributed his success not to a single gimmick, but to a rigorous intellectual process. Kovner's strategy was to develop a clear mental map of the world, understanding the fundamental forces, political, economic, and psychological, driving various markets. He would then formulate a low-risk thesis, a hypothesis about a future market move. Critically, he would wait patiently for the price action to confirm his view before entering a trade. He believed the market itself had to validate his fundamental analysis. His risk management was legendary and absolute. He would predefine his exit point on every trade and would get out the moment his initial premise was invalidated by the market, regardless of profit or loss. He famously said, "If you don't work hard, it's a short trip to the poorhouse." His approach was one of intense 24/7 preparation and disciplined patience, treating each trade not as a bet, but as a calculated campaign based on a well-researched strategic vision. The world of foreign exchange has its own titans, chief among them Bill Lipschutz. His strategy is rooted in a deep fundamental understanding of the factors that drive currency valuations: interest rate differentials, capital flows, trade balances, and political stability. Unlike traders who rely solely on charts, Lipschutz builds a fundamental thesis for why one currency should appreciate against another over a medium-term horizon. He views the FX market as a 24-hour game of chess, requiring immense stamina and the ability to process a constant stream of information. A core component of his strategy is structuring trades with highly asymmetric risk-reward profiles, often using options to define risk and create leverage. He also emphasizes the psychological aspect of the market, understanding that perception can be more powerful than reality in the short term. His success is built on a foundation of rigorous fundamental analysis combined with a trader's instinct for market structure and risk management. Our 14th Titan is a master of chaos and fear, David Tepper. His strategy is centered on distressed and special situations investing. Tepper built his multi-billion-dollar fortune by buying the debt and equity of companies and even countries on the brink of collapse, at the moment when fear is at its absolute peak. His legendary trades in the senior debt of failing banks in early 2009, when many thought the entire financial system would fail, are a testament to his approach. His strategy is to conduct exhaustive, bottom-up research to determine a company's true survival prospects and its liquidation value. He then acts with extreme conviction when the market price, in a state of panic, reflects only the worst possible case scenario. He famously stated that in times of crisis, you get that feeling in your stomach. That's when you have to buy. His strategy is one of calculated courage, combining deep value analysis with the psychological fortitude to buy when everyone else is selling in terror. Finally, we examine Seth Klarman, a titan of risk-averse value investing. While a disciple of Graham, Klarman's strategy is distinguished by its absolute obsession with capital preservation. He defines investing as the intersection of economics and psychology. His methodology involves a patient, disciplined search for value in unpopular or complex areas of the market, such as spin-offs, post-bankruptcy equities, and complex liquidations. He is a master of finding situations where assets are being mispriced due to structural reasons or institutional constraints. Klarman is famous for his willingness to hold large amounts of cash for long periods, sometimes years, waiting for what he calls forced sellers, institutions or individuals who must sell an asset regardless of its price due to panic, margin calls, or fund redemptions. His strategy is to be the rational, liquid, and prepared buyer on the other side of that panic. It is the ultimate discipline of patience, waiting for the perfect pitch instead of swinging at every market offering. In reviewing these 15 methodologies, a powerful truth emerges. There is no single correct way to conquer the financial markets. The market is not a static problem with a single solution. It is a complex, adaptive system constantly evolving and reflecting the chaotic sum of human decisions. An environment of high inflation and central bank tightening that favors the macro analysis of a Paul Tudor Jones would be hostile to the long-term growth-oriented approach of a Philip Fisher. A volatile, range-bound market that provides fertile ground for a short-term trader like Linda Raschke would frustrate a trend-following system like the one used by Richard Dennis. The paths to success are therefore as varied as the market environments themselves, and as unique as the titans who navigated them. We have seen the entire spectrum of strategic thought. On one end lies the pure speculator like Jesse Livermore, a master of timing and psychology who treated the market as a battlefield of emotional currents. On the other end is the meticulous engineer like Ray Dalio, who views the market as a machine to be deconstructed, understood, and navigated with an all-weather system designed for resilience. We've examined the corporate warrior in Carl Icahn, who doesn't play the game on the board but instead seeks to change the rules of the game itself by forcing corporate change from the inside. This stands in stark contrast to the pure quant Ed Sikota, who removes himself from the equation entirely, trusting a computer system to make decisions free from the biases and fears that plague human judgment. Some, like David Tepper, run toward the fire, finding their greatest opportunities in the ashes of corporate distress. Others, like Seth Klarman, patiently hold cash for years, waiting for the fire to burn out so they can sift through the wreckage for bargains. The common thread that binds these disparate approaches is not the method itself, but the meta-principles that underpin their execution. These can be distilled into 3 pillars. First is a deeply understood and coherent philosophy. None of these titans merely rented a strategy. They built or adopted a worldview that was an extension of their own intellect and temperament. This conviction is what allowed them to act with certainty when others were paralyzed by doubt. Second is a clearly defined and verifiable edge. Each titan knew precisely what their advantage was. For Joel Greenblatt, it was the statistical power of his magic formula. For Bruce Kovner, it was a rigorous, process-driven approach to global analysis. For Bill Lipschutz, it was a profound understanding of the fundamental drivers of currency markets. They did not attempt to be masters of all domains. They focused on mastering one. Third, and most importantly, is iron-willed discipline. This is the bridge between analysis and profit. It is the discipline of Seth Klarman to hold cash when surrounded by temptation. It is the discipline of Richard Dennis's turtles to take every signal their system generated, even during a long losing streak. It is the discipline of Paul Tudor Jones to cut a trade the instant his 5-to-1 risk-reward thesis was invalidated. Without this final pillar, the first 2 are merely academic exercises. This brings us to a critical question, and we want to hear from you in the comments below. After examining this diverse collection of methodologies, who do you consider to be the greatest market operator of them all, and why? Which strategy do you believe is the most robust for the markets of the 21st century? Furthermore, which of these titans would you like to see us dedicate an entire deep dive video to? Your feedback guides the future of this channel. Ultimately, their careers are the ultimate proof that success is not found by chasing hot tips or imitating gurus. It is found by undertaking a rigorous process of self-examination. The goal is not to become Jesse Livermore, but to learn from his principles of risk and apply them to a strategy that aligns with your own psychology, your own time horizon, and your own tolerance for risk. The path to becoming a successful market participant is a path of building a robust philosophy, identifying your unique edge, and then cultivating the relentless consistency to apply it day after day. That is the foundation of a career that lasts.